Welcome back, learners. I'm your host, and today we're jumping straight into a rigorous definitive revision explainer on AQA Topic 3.1.3, Markets and Marketing Data. If you're looking to truly master your quantitative marketing skills and elevate your critical analysis for your exams, you are in exactly the right place. We're going to break down the core theories, apply the vital mathematical formulas, and climb all the way from foundational AO1 right up to top-tier AO4 evaluation concepts. Let's get started. Okay, let's take a quick look at our agenda for today. 1. Market types and conditions. 2. Analyzing size, growth, and share. 3. Sales data and performance. 4. Interpreting data correlation. And finally, evaluating market success metrics. All right, let's dive right in. Section 1. Market types and market conditions. First up, we've got to establish the environment a business is actually operating in, because, well, that dictates literally every strategic marketing decision that follows. Let's start with B2B, business-to-business markets. This is where transactions happen strictly between companies. Picture a massive wholesaler selling raw materials to a manufacturer. In B2B, your marketing heavily relies on rock-solid client relationships, the expertise of your account managers, and super rational, data-driven purchasing behavior. Emotional appeals? They rarely work here. It's all about efficiency, cost savings, and hitting that return on investment. On the flip side, we have B2C, or business-to-consumer markets. Here, businesses are selling directly to individuals, people like you and me. In this space, emotional branding, a distinctive corporate culture, and mass market positioning are absolutely paramount. Think about how a brand like Gymshark uses incredibly strong branding to make their target market way less sensitive to price changes, or how Netflix leverages its innovative culture to keep its service super competitive. B2C marketing is all about connecting deeply with a consumer's lifestyle and their personal needs. Now, what's a really fascinating evolution in this space is the C2C or consumer-to-consumer model. This market space is hugely facilitated by digital e-commerce platforms. Think of those apps where everyday users are trading secondhand clothes or selling handmade crafts directly to one another. The platform itself simply provides the digital infrastructure. The actual marketing, that relies heavily on peer reviews, building trust, and driving community engagement. But moving beyond just who we're selling to, we also need to sharply contrast what exactly is being sold. Marketing a physical, tangible good, like a bicycle or a smartphone, differs fundamentally from marketing an intangible service. Goods can be stored in a warehouse, physically demonstrated, and perfectly standardized. Services, though, they're highly variable. The quality of a service often depends entirely on the specific employee delivering it at that exact moment in time. Because of that, service marketing focuses intensely on customer relationship management and rigorous staff training. So, the crucial takeaway here is that a business doesn't just operate in a vacuum. We absolutely have to look at the broader market conditions. We're talking about the degree of competition, competitive behavior, and market growth rates. High degrees of competition or super rapid market growth will force businesses into reactive and proactive strategies. They might be forced to adopt dynamic pricing, where prices are constantly fluctuating based on real-time demand, or they might have to aggressively push new product development just to hold on to their current market share. All right, it's time to put this theory into practice. Learners, pause the explainer now and complete Task 1. I want you to really apply your AO3 analysis skills here. Focus on connecting competitive intensity directly to concepts like the price elasticity of demand and the product life cycle. Think about how a massive fast fashion firm like Shein has to constantly adapt its pricing and its product portfolio just to survive in that brutal environment. Let's move on to Section 2, Analyzing Markets, Size, Growth, and Share. Transitioning from our foundational AO1 knowledge into some rigorous AO2 application, you've got to memorize these standard equations. Take a look at the formulas in the table. Market share is simply the sales of one specific brand divided by the total market sales, all multiplied by 100. Market growth is the change in market size over a specific period, divided by the original size times 100. Now, note carefully that market size represents the total potential demand, and that is the crucial denominator in our share calculations. I've thrown in some dummy data for a fictional brand on the right, and we're going to use that right now. Grab your calculators, learners, pause the explainer now, and complete Task 2 using the data from the previous slide's table to extract those vital percentages. And remember, the exam board doesn't just want to see you calculate a number, they will always test your ability to interpret what those numbers actually mean for a business's competitiveness. Okay, we're back. If you calculated a market share of exactly 14.5%, Excellent work. This brilliantly illustrates how a business quantifies its relative competitive strength within a growing market. Seriously, a growing market size combined with a rising market share, that's the absolute holy grail for any marketing director. It proves you're outperforming your rivals and capturing that brand new demand. Let's jump into Section 3, Sales Data, Measuring Performance. Beyond those broad market metrics, we really must drill down into a firm's specific internal sales data and marketing performance to judge if a strategy is actually working. Now, here's a massive trap that so many students fall into. Never, ever confuse sales volume with sales value. Sales volume is just the total number of physical units sold. Sales value, on the other hand, is the total monetary worth of those units. Why does this matter? Well, imagine achieving a sky-high sales volume through heavy penetration pricing, meaning you set a dangerously low initial price. That might actually result in a declining overall sales value, which is going to severely impact your profit margins if your costs aren't strictly controlled. Furthermore, AQA examiners absolutely love testing your ability to use index numbers and percentage changes to identify long-term trends. Let's be honest, looking at a single static number tells you very little. But by converting sales data into index numbers, like you can see here across these financial quarters, we can easily track performance trends across different geographical regions or distinct segments of a product portfolio. It's incredibly useful for helping managers spot exactly where a product sits in its life cycle. Ultimately, though, every single marketing campaign, whether it's fancy search engine optimization, a massive social media push, or a primetime TV advert, must be justified by its return on marketing spend. This is a very specific type of return on investment, or ROI. You calculate it by dividing the net profit generated by the initial marketing investments. Basically, if the ROI is negative, that campaign literally destroyed value. All right, Section 4, Data Correlation Interpreting Patterns. Next up, we need to examine how marketers actually find patterns hidden within all this vast data by looking at statistical relationships. Marketers need to know if two variables are actually linked. Understanding whether variables move in the same direction, which we call a positive correlation, or in opposite directions, a negative correlation, is incredibly powerful stuff. For example, recognizing a negative correlation between price increases and sales volume helps confirm that you're dealing with highly elastic demand. But we also have to look at the strength of this link. A strong correlation means the data points are tightly clustered together, making your predictions highly reliable. A weak correlation, however, suggests that a bunch of other variables are probably influencing the outcome. Spotting these relationships allows firms to accurately anticipate cyclical or seasonal demand shifts and tweak their marketing mix accordingly. And finally, Section 5, Evaluating Metrics for Market Success. We've now reached the absolute pinnacle of A-level assessment, AO4 evaluation. This is where we have to weigh up the usefulness and, crucially, the limitations of the very metrics we've just learned to calculate. Let's contextualize this within a highly dynamic sector like the B2B technology market. Think of companies out there developing cutting-edge virtual reality headsets or massive AI infrastructure. In these markets, innovation totally outpaces standard product life cycles. We're talking massive investments required right up front. Because of this rapid, relentless shift, relying purely on static, historical data snapshots can quickly lead to what we call strategic drift, which is where a business's strategy simply no longer fits the fast-moving environment around it. Which brings us to your final challenge today. Pause the explainer now and complete Task 3. I really want you to evaluate whether market share is truly the most reliable measure of success in this specific, rapidly changing tech context. Try to form a balanced, well-supported judgment that explores both the value and the real limitations of using market share as an absolute metric. Welcome back. Let's debrief on that. A top-tier evaluation for this task would argue that sure, while a high market share definitely indicates current dominance and gives you perhaps some sweet economies of scale, it is fundamentally backward-looking. In a crazy dynamic tech market, sustained investment in new product development and a high return on investment are far, far better predictors of your long-term survival. Chasing market share with outdated tech, that's just going to accelerate your strategic drift right out of the industry. As we wrap up this masterclass, I want to leave you with a final, provocative thought. We've spent this entire session analyzing formulas and crunching historical sales data. But if quantitative data can strictly only show us what has already happened, how does a truly entrepreneurial business leverage that information to predict and completely dominate its market's future? Think about that as you continue your revision. Thank you so much for joining me, and keep applying those critical analytical skills.